Thanks for the very interesting introduction. Actually, this is my fourth time speak at this conference. I'm always impressed by the caliber of speakers. Well, basically, the advantage of speaking at a conference is that I can get away with anything because most of the things you said will be forgotten tomorrow. So hopefully you only remember what I said correctly last time. Hopefully that will make some good prediction this year. The obvious question today is, actually it's coming from my client. They phoned me up a few days ago saying, well, Chen, what are we going to do this year? Stock prices have gone up 30%. Should I stay in the market? Well, the easiest thing for me to do is to go back to history and look at historical precedents. Actually, I've done some digging. Since 1840, there are a total 30 occurrences where annual returns in US equities exceeding 25%. Out of these 30 times, 22 occurrences are followed by another year of positive price increases with the mean return of 13%. So right at the beginning, you have a 70% chance of another positive year this year with average return of 13%. So don't call me if you don't get that. But I'm just giving you a statistical fact, okay? Obviously, what the stock market is going to do will depend on the world economy, financial markets, all those things. So I think what I'm going to do today is to really divide my talk into three parts. The first part is really making some brief comments on world economy. What are the major macro stories that's going to dominate the world? That's my first part. The second part, I will try to relate that macro story to financial markets. And then I try to conclude my little presentation with some money-making ideas, or at least let's try to lose a little bit less. Let's see how to benefit from all the stories. Now, on the world economy, I think this year there are three dominant macroeconomic stories that we will experience. The first thing is we will see some synchronized global growth. If you think about the world economy over the, I would say since the end of the Second World War, most of the time the world economy is more or less in sync most of the time, but not over the last 4 to 5 years. If you think about the major economic blocks around the world, the US economy has been very steady, moving along a path of 1 to 2%. We have had quite a few episodes of instability, concerns, worries, whether we're going to have a double-dip recession or not in the US, but nonetheless, the economic growth in the US has been incredibly steady. That's Europe, that's US. Now, if you think about the Eurozone economy has made a classic double-dip recession. The first contraction took place in 2008 and 2009, followed by a very brief recovery in 2010, and then second down leg in 2011. So if you look at the Eurozone, it's a double dip. Now, if you think about the Chinese economy, the economic profile of China is completely different from everybody else. We had a huge acceleration in 2009 and 2010. We all understand why, because the Chinese government basically threw in a huge fiscal stimulus. We had a major reacceleration in China and followed by a very substantial economic deceleration. So actually, if you look at the last quarter, 2013, the quarterly sequential growth in China was basically bottomed at about 6.5%. So that's China. Japan is very pathetic. I mean, if you think about the Japanese economy, it's really sad. Had a very deep contraction in 2008. Just about the time when the Japanese economy was about to recover and was hit by this tsunami and the nuclear disaster, and actually it never really recovered at all until very recently. So this has been the world economy. We're all over the map. The good thing now is that for the first time, I think in a long while, do I have my chart here? Oh, okay. For the first time in a long while, we will have some growth resynchronization. If you look at the US, I think the US, don't look at too many indicators. The best indicator in the US economy is equity to bond ratio. So if you look at your left-hand side, the red line is equity bond ratio. That is always giving you very good prediction of where the US economy is going. So the equity bond ratio today, there are only 4 periods where the equity bond ratio reached today's level. If you go back to 1960s, okay? So basically it says we are looking for some substantial growth reacceleration. Actually, it's very simple. If you think about removal of 1.5% physical drag, you're really talking about 2.5%, maybe 3% growth in the US. Eurozone, don't ask me why this model is doing this. You just trust me, this is something that hasn't worked. The Eurozone probably is ending its contraction as we speak now. The red line is our model, has been always very reliable, basically telling me that the Eurozone contraction is ending. How strong the economic growth rate will be in the Eurozone, I don't know, I don't care. What do I care is this. The Eurozone, the size of the Eurozone economy is almost as big as the United States. So as long as that economic bloc stops contracting, the contribution to the world economic growth will be enormous. So I don't care whether they're going to have a good growth. I don't think they're going to have a very good growth, but I do care about the contraction coming to an end. China, I don't want to spend too much time, but I will probably talk about it later on. But the Chinese economy, you probably heard the Chinese Prime Minister said he never trusts the GDP number. He only looks at railway transport volume, electricity consumption. Just trust me, these 2 series have made a double bottom towards the end of last year. Right now, we're probably on the upswing. I don't think we're going to have a major reacceleration in the Chinese economy, but I think the growth acceleration this year in China will be obvious, but steady, okay? Japan, obviously, the Abenomics worked. If you look at the key indicators, I don't care whether it's a Tankan survey, I don't care whether it's consumer confidence, retail, so all those things are going up. They are going up. So the Japanese economy is recovering. So all I'm saying here is, if you look at the world economic activity, the blue line is the global industrial production. I think right now the indicator tells us that we are looking at about a 5, even better than 5% growth expansion in the world manufacturing activity. That is the most cyclical sensitive indicators of the world economy. It basically says that we are going into a much better world. So the first story that you have to keep in mind is global resynchronization. The second major economic story that I think is very important as far as investors are concerned is restructuring in Asia. Japan and China in particular. They are all doing very aggressive economic restructuring, but with a completely different focus. The Chinese restructuring is very much focused on supply side, while the Japanese restructuring is totally on the demand side. If you think about Japan, most people will ask this question: will Abenomics resolve the structural problem? Well, actually, if you think about this question, it's quite superficial in my view. You ask them back, you say, what is the Japanese problem? what the Japanese problem, you will get the immediate response. Well, the Japanese problem is that they basically have very low growth, stagnation. If you look at the economic growth rate, yes, there's no question about it. For the last 15 years, the average growth rate in Japanese economy is 1%. Pretty lousy. But if you adjust for labor force, which is contracting 1% every year in Japan, per capita GDP in Japan is about 2%. What is per capita GDP? Per capita GDP is labor productivity. So if you think about the US economy has the average growth rate for the last 15 years or so has averaged about, what, 3.5%? So if you adjust for labor force, which basically grows 1% a year, you're talking about maybe 2.2% per capita GDP growth. So the productivity level in Japan is almost as good as the United States. The Japanese are not like Italians, they don't work. They do work. They almost work as hard as Americans. So the problem in Japan is not on the supply side. I think the problem in Japan has always been on the demand side. If you allow price deflation to take hold, then you changed your economic incentive structure. If everybody here knows that a price will always fall, then nobody want to be a borrower. Everybody want to be saver. The problem is entrepreneurs, investors tend to be borrowers. So you punish those who want to invest, you punish those who want to borrow, and you basically subsidize those who save. So that's the problem for the Japanese economy. It's a twisted incentive structure. That's why I think people say the first arrow, second arrow of Abenomics. I think you don't need that many arrows. Just one mother of all arrows, which is monetary reflation. Get down your currency, get inflation back. You will restructure your incentive structure of the whole economy. I think he's doing the right thing. He's doing it successfully. Because if you look at all the indicators, it just shows that the measures that has been taking place is working. Now, move to China, supply side. I think I'm very bullish on what's going on in the Chinese economy. The reason is, if you ask a typical Chinese, there's a huge amount of dissatisfaction of what happened over the last decade. Even though the economic growth rate was very good, but they call the last decade as a lost decade in terms of economic reforms, because the Chinese government, the previous government, didn't do anything to advance the market-oriented reforms. If anything, if they did anything, it's basically regress a lot of reform that was put in place in the 90s. For example, if you look at the state monopolies become huge. If you look at the tax revenue, the distribution of that, the central government basically re-centralized the whole revenue base, forcing the local government to rely on land sales for their own infrastructure spending. So the previous government basically didn't do anything in terms of restructuring, and Chinese people don't understand that. So I am very bullish on what is going on in the current government, because the current government only in power for about 5 months. They have already announced 64 major measures to dismantle the state monopolies, to liberalize the system. Basically, they are not going to rely on credit expansion to stimulate the growth. They are talking about growth reform dividend, meaning they want to liberalize the system, allowing private business to invest in areas that are previously closed to them. That way, they want to generate some supply-side expansion. I think that is what is going on in China. These two reforms, one in Japan, the other in China, will have very important market implications. I will talk about that later on. So that's the second major macroeconomic story that people need to keep in mind. The final thing The third major macro story that I think will have a very important investment implication is the fact that the industrialized world is very close to deflation. Actually, I just did some quick count. Out of 22 industrialized countries, 18 of them have domestic inflation rate that is below 1%. If you have 1% inflation rate, you are well within statistical error of deflation. You really don't know. The price increase of 0.5%, is that real? I mean, it could be absolute zero, could be minus, we don't know. So the point here is, if you look at these two charts here, everybody understands why Eurozone will go into deflation, because it's a classic dilemma of devaluing versus deflation. If you cannot devalue, then you have to deflate. But if you look at that chart on your right-hand side, that's UK. So let me explain what this is. The red line here is the so-called diffusion. It is basically it's inflation diffusion index. It's basically you take the inflation, the CPI basket, you measure those components that are going up versus those are going down. Basically, that's the red line here. The UK is supposed to have the highest inflation in the developed world. You look at the inflation diffusion index, it basically tells you that UK inflation rate is going to blast down very quickly. So all I want people to remember here is, well, a lot of people are still worried about Fed money, money printing, inflation. The world, at least the industrialized world, is going through deflation or very, very low inflation period. It basically tells you that there is still an aggregate demand problem. The world saves way too much, consumes way too little. That's basically what this inflation picture tells you. So, to sum up, macroeconomic story here is dominated by three things. Resynchronized economic growth this year, economic restructuring, both in Japan and China, but with very different focus, and extremely low inflation in the industrialized world. So these are the macroeconomic story going forward. Now, let's move to the second topic. What this macro story really mean for financial markets? Well, if this is a real story, it at least means three things as far as financial markets are concerned. The first thing, if we have resynchronized growth, we will have earnings reacceleration. If you look at your left-hand side, that's the earnings model for the US stock market. We had a huge earnings recovery between 2010 all the way to 2011, followed by a very pronounced earnings growth deceleration. Last quarter, we're talking about 2 to 3%. But if this global resynchronized economic growth rate plays out to be the case, the earnings will reaccelerate towards something like 20%. That's my model. The consensus right now is about what? 12%, 12 months out. My model is basically saying maybe it's 20% in that range. Regardless, we will see earnings expansion. That's the first thing that you have to keep in mind. The second thing is, if we have resynchronized economic growth around the world, the yield curve will stay very steep. Okay? If you look at the panel on the right-hand side, if you look at the history, equity multiples, PE ratios, are always positively correlated with the steepness of the yield curve. It's very simple. Whenever you have a steep yield curve, it means monetary policy is easy. It means earnings are expanding. Most likely, you have a higher investor confidence. So that's why if you look at the correlation, as long as you have a steep yield curve, the equity multiples are going up. So that's why I think we will have some PE inflation going forward. Okay? Thirdly, if this global resynchronized growth plays out, it will mean market correlations start to fall. If you think about it over the last 5 years or so, the market are all highly correlated. You basically have a risk on and risk off trade. If you are betting on risk, you buy stocks, you basically sell bonds, you basically have to go long the dollar, you have to go short the dollar. That's a risk on. If you bet it's risk off, then you do the opposite. There's really no choice of asset diversification. So if this global resynchronized economic growth rate really becomes the story, we will see a declining market correlation. Now, if you can see that the equity market correlations has been changing already. If you look at equities and commodities, they have parted ways. If you look at equity and bonds, they have also parted ways. If you look at intra-stock correlations, meaning if you look at the intra-stock correlation within S&P 500, it has fallen to, I think, 10-year lows. So for the first time in a long while, we start to have a choice of asset diversification. That's what it means. So in other words, if this macro story plays out correct, then we will have three things happening. A, profit reacceleration. B, steepening yield curve together with multiple expansion. C, we are going to see a continued decline in market correlations. So these are the three financial market implications. Now, let's move to the last topic. How do we make some money, or at least how do we lose a little bit less? What are the stories here? Well, the first thing you have to notice is that stock prices have indeed gone up a lot. Some people that saying that the equity market is expensive, we are already sort of getting into bubbly territories. They may be right, but I think we should keep this picture in mind. What is it? The top panel here is S&P 500 stock prices, the equity index, the blue line. The red line is earnings. So the bottom panel here is forward PEs. As you can see, during the entire duration of this bull market, the PE ratio today pretty much set at the same place a couple of years ago. Meaning, this bull market actually can be decomposed into two phases. The first phase actually was really from 2009 all the way to 2012. During that phase, earnings expansion was much faster than stock price appreciation, leading to a decline in PE ratio. For obvious reasons, everybody was concerned about double-dip recession, everybody concerned about euro breakup. There's a lot of fears. There's a huge equity risk premium that is being imposed on the stock market. That's why we had a massive decline in PE ratios. And only after 2012, we have a period where stock price appreciation exceeding earnings growth. So basically, for the entire duration of this bull market, there's no systemic PE expansion. So we are basically sitting at the same level as in 2009. Okay, I am not saying the stock market is cheap. I'm not saying that at all. I'm just saying you have to keep this picture in mind. This bull market so far has been can be decomposed into two phases. But I'm saying probably stock market right now is fairly valued. Okay, why? Because, I mean, if you look at this index, put this way, you can tell any story you want. Okay, if you look at your left-hand side, that's sort of a so-called the relative value index we often look. What is it? It basically is look at stock prices in relation to all the competing assets. You know, for us, we allocate assets. We're not only looking at stock price, we also look at the competing assets, meaning bonds, real estates, probably sometimes commodities. So that basically is the so-called relative value index. Well, it's probably slightly overvalued, but not hugely in terms of stock market. I think probably the reason that stock market is showing a little bit overvaluation is probably because real estates in the US is very cheap. That basically increased the relative value of equity markets. If you look at the composite valuation index, basically you take weighted average of all valuation index, price to book, price to cash, price to earnings, you got a bit of overvaluation. That is on your right-hand side. The bottom line here is you can tell any story you want. My sense is probably we're fully valued, meaning any additional price gains will probably push us into sort of a expensive territory, but it doesn't matter. The question is whether the broader macroeconomic condition will change so that the bull market will die. I don't think that is going to be the case. The point is this: if you believe that the Fed is still manipulating interest rate, well, actually, it's a debatable issue. But if we believe that the Fed is keeping short rate at least at a level that is much below equilibrium, then the natural conclusion that we must have is that this very low interest rates will overstimulate growth, will overstimulate profit, will overstimulate asset prices. That is what the Fed wants. Actually, they understand that if you are in the liquidity trap, the only channel where monetary policy can make a difference is through exchange rate and asset prices. Basically, you have to rely on the so-called wealth effect to have an impact on spending pattern. That is why actually they almost said that explicitly, that they want to have a higher asset value. So I don't want to fight the fight. I don't want to fight the Fed. That's why I think the basic condition for this asset bubble, asset price inflation, remain in place. As we said, the inflation rate is a non-issue today. That's why I think you don't want to be too negative on stock market. In terms of which market to buy, there are a couple of thoughts. I think there are a couple of thoughts you might want to consider. Japan is a clear story. I think the Japanese equity market has much further to increase. The reason I'm saying that is this: if you look at the relative performance of Japanese equities since 2001, if you look at your left-hand side, the total returns in the Japanese equities in US dollar terms is exactly the same as benchmark. They haven't done any better, they haven't done any worse. Meaning, the underperformance of the Japanese local index, the Nikkei, has been entirely made up by appreciating yen. That's why we basically end up with a benchmark performance in terms of equity market returns. If you think about Abenomics, what is it? The Abenomics basically trying to redistribute the nominal variables, meaning they want to have a lower currency, higher domestic prices, because last decade, for over a decade, they have allowed sustained currency appreciation to depress domestic asset value. Going forward, they are trying to redistribute these two variables. They are initially successful. I think the game is not over yet. If you look at the other side of the chart here, the red line here is trade-weighted yen. The blue line is CPI inflation. It's pretty obvious that in order to sustain 2% inflation, as they said they want to generate, as BOJ said, then the yen has to go down further. I think 120, 130 is that's all possible. So in that case, you have to be long the Nikkais, meaning you have to be long Nikkei but completely hedge your currency exposure. That's a clear game going forward. Now, people ask me whether that game, the currency devaluation, will be successful in generating sustained inflation in Japan. I think I don't know. I don't care. What I care about is the process. They are still in the game of devaluing the currency in order to generate the initial impulse behind inflation. As long as they are trying, you want to be short the yen and you want to be long the stock market. That's it. Over a long period of time, whether the currency depreciation will generate sustainable inflation or not, I don't think so. But again, that's the story probably 2 years down the road, not this year. This year will continue to be reflationary game here. The second thought, I haven't figured out how to profit from the Chinese restructuring story because it's a supply side reform. Supply side reform typically is very painful. It's especially painful for the state-owned enterprises. If you think about the Chinese banks, they are trading at about 5-6 times earnings. People saying that the Chinese banks are discounting a big blow up in the real estate market. I think they got it wrong. The property market is still, we're talking about a bubble, Chinese property bubble for about 5 years. The prices keep creeping up. So, if you are managing money, you keep getting the wrong call, you'd be fired. But, as a forecaster, you can say anything you want. But the problem with the Chinese banks, in my view, is that the market already sniffed out the impending reform, the financial market liberalization. What happens? Well, if they liberalize interest rates, you know what? The bank spread will go like that. Today, the banks are paying out 1% on deposits. They are collecting 7-8% from loans. If you liberalize the deposit rates, the bank spread will go like that. You're going to have a massive haircut in profits. That's why the Chinese banks are trading at 5-6 times earnings. So, I think the clear winner of the supply side reform in China is small caps. I think market is basically figuring that out. If you could look at the relative performance, which is on your right-hand side, that is Chinese small cap relative to large cap, is already taken off. I think they've got further to go. There are a few ETFs on Chinese small caps, but I don't want to talk about that too much. But that is a story that you have to keep in mind. Another thing is, if this macro story of low inflation or even deflation plays out to be correct, then you don't want to be too bearish on long-term government bonds. Let me tell you this. If you think about 30-year yield today, 30-year yield stand at 3.9%. 3.9% is actually higher than the average nominal GDP growth for the U.S. economy since 2008. Much higher. I think if you calculate the nominal GDP growth for the U.S. economy for the last couple of years, it's averaged about 3.4% maybe. 30-year yield, I think, is already at equilibrium. It's not bad at all. You are very well compensated by holding that. So all I'm saying is, at farther end of the yield curve, you don't see Fed manipulation. But once you going to the shorter end, once you move towards the shorter end of the curve, you see more Fed. Just to give you an example, 10, 30-year, in the post-war period, the average term premium between 10 and 30-year yield, the average term premium is about 16 basis points. 1/6. So if you agree with me that the 30-year is already at equilibrium or very close to equilibrium, then 10-year yield should be something like 3.6, 3.7 in that range. If you apply this classic average term premium since 1950s. So clearly, there's a Fed there. That's why I think in terms of bond market, first of all, I don't want to be too negative on the very long end. On my 30-year, I think it offers very good value already. But 10-year probably got further to go, especially when the Fed stops the so-called quantitative easing. But that would be I don't think this would be this year's story, probably 2015. That's one I think the stock market will have a major problem. The final thing, I have 0 minute left. Anyway, I'm bearish on commodities. I'm sorry. Full stop bearish. I think the commodity story is the last decade story built on 3 things. A sustained decline in the dollar, the lack of supply side response, and the growing Chinese demand. Going forward, I'm very bullish on the dollar. I think dollar today is very similar to where the dollar was in the second half of 1990s. Okay? So here go one big factor behind the bull market in commodity. If dollars keep strengthening, forget about the bull market in commodity. This is not going to come back. Supply side, I sort of agree with the previous speaker, but I don't agree totally. I think the shale oil is very real. If I look at the U.S. oil production, it's up like 35% in a space of 6-7 years. That's a huge increase. So supply side, I mean, look at the copper supply. It's going through the roof. So the supply side is there. Chinese demand will remain to be very strong, but out of 3 factors, you remove 2, so we're done. The bull market was the last decade story. So that's why I think you want to be bearish on commodity plays, commodity stocks. I mean, Canada, we're done. I think it's still, finished. Anyway, I will stop right here. So if you have any questions.
0 minutes. So you are short on minutes, but long on good advice for the audience here today. And you are bullish on equity, on stocks. And one question is, what about the emerging markets and then versus some of the more mature markets?
All right.
How would you weigh it?
That's a tough question. I don't want to answer, but I have a story here. Anyway, I think the emerging market is very different today than what it was 10 years ago. They're all over the map. I don't think you should treat them as a asset class. You have to treat them separately. If you have to invest in emerging market, though, here's my chart. How come my chart is gone?
We'll bring it back.
Can I?
We will bring back your...
That's him.
No, that's him.
Yeah.
Here's your chart.
Oh, here is my chart here. Look at this panel here on your right-hand side. The blue line is Asian stock market relative to Latin America. So if you think about last decade, the big trade last decade was to go long the Latin American stocks and go short the Asian markets. The story behind that is very obvious. The commodity. I mean, we had a huge boom in commodities. The LATAMs are all commodity producers, so the natural trade of the last decade is to go long the producers and to go short the users. So if I'm right that commodity story is the last decade story, then you want to flip the trade, and then you're going to make a fortune. Meaning you want to be long users, Asia, short producers, Latin America. So that's my story.
One more question about the Chinese market. You said you were bullish on Chinese small cap, and I guess Chinese small cap is relatively large.
No, they are pretty tiny.
But you have like we heard earlier, you soon have 200 cities with more than 1 million.
Well, that's the people.
Yeah, I know.
That's not a stock market.
I know, but how small are they, and what are the risks?
Well, there's a lot of risk. I mean, there's a liquidity risk. There's a whole bunch of. Also, that's what I'm just don't take my previous statement too serious. Just as an idea. The reason I'm saying that is, the Chinese small caps, they are clear. They will be the beneficiaries of this supply side reform. There's no question about it. But not necessarily on those listed companies. Some of those listed companies got poor governance, a whole bunch of issues. But some of them are good. So that's why I cannot give you any advice. You have to get some portfolio managers to look into some of the small caps, and they have to be read on the sectors that will be benefiting from the so-called liberalization. Just telecoms, railways, these things.
Supply side companies.
These things now, before the private businesses are not allowed. Now they are opening up these sectors. These sectors are allowed the private participation. That is a huge deal in my view. But who is going to benefit from that? I don't know.
And finally, how is the threat of a credit bubble?
I can spend days talking about that. I don't agree with that statement to begin with. I think that is a very profound question. Is there a credit bubble? I pose that question to everybody. If you think about credit, what is credit? Credit occurs when you convert savings into investment. Is that correct? That has to be correct. Okay. Now, think about the Chinese economy, 50% savings rate, 50% domestic savings rate. To convert that 50% savings into investment, is it correct to say that their credit has to grow at a fairly rapid pace?
Yeah, they all agree.
So, next time when they ask you that question, here's the answer. Those guys basically saying that they have a credit bubble. Basically, they have raised a unresolvable problem because they saved so much. They have to convert that saving into investment, and the only viable way for them to do that is through the borrowing market. If you think about the United States, the U.S. does not have to go through the borrowing market. They got an equity market that is very deep and functioning, and it's easy to convert savings into investments through the equity market. The Chinese equity market is very narrow, it's very small. It's not enough. They have to go through the borrowing market, otherwise the economy stops. I mean, savings investment, that is basic saying. So that question sounds very profound. Actually, I think it's very superficial.
It's gone. It's gone. Thank you very much.